Welcome to The Deep Dive, your essential shortcut to truly understanding what's moving the markets and why. Today, we're unpeeling the layers of Havells India Limited's Q1 fiscal year 2026 earnings call. For us, these calls are far more than just a numbers dump. They're, where the real strategic narrative of a company emerges, giving us crucial insights into its health, its challenges, and its future trajectory.
Absolutely. And this quarter for Havells certainly presented a complex picture. Management openly acknowledged it was a challenging period. However, the consistent message threaded throughout the call was a strong belief that these headwinds are temporary or, as they put it, transitory, and that confidence in their long-term growth prospects remains unshaken. Our deep dive today is precisely about unpacking that nuance, going beyond the immediate headlines to uncover the strategic maneuvers Havells is making to not just weather the storm, but, well, to position itself for sustained growth.
Right. Let's start with a snapshot then, just how the quarter played out financially. The narrative from Havells was that Q1 was indeed tough. They pointed fingers basically at an unexpectedly weak summer season and, well, persistent subdued consumer demand. This combination significantly weighed on their cooling products revenue, and especially because they were up against a very strong comparable period from last year, right? Which made the current decline look even sharper.
It's true. The consumer side faced significant pressure. But what's fascinating here is how Havells responded operationally. Despite those clear headwinds, management demonstrated a keen focus on cost discipline. This isn't just a buzzword. It resulted in only modest growth in expenses, which indicates, a concerted effort towards better operational efficiency and protecting their bottom line. And this is where Havells' diversified portfolio really shone through. Demand from the infrastructure and industrial sectors continued to drive robust growth in their cables and wire segment. That counterbalanced some of the consumer weakness. So while parts of the business experienced a chill, management's confidence in the, let's say, transitory nature of these challenges suggests they anticipate a recovery. They expect both revenue growth and margin improvements over the coming quarters.
That's a critical distinction to make. Let's really dig into those specifics now, starting with that consumer side, particularly cooling products like residential air conditioners, RAC fans, and coolers, and also the Lloyd brand. You mentioned the difficulties. Can you elaborate a bit on why the decline for these categories was so profound and what the inventory situation looks like?
Certainly. The decline in cooling products was indeed exacerbated by two main factors: that strong prior year base, which set a high bar, and, well, the unexpectedly weak summer. Essentially, people just weren't buying ACs and coolers when the weather wasn't cooperating. Simple as that, really.
Makes sense.
And this led to a significant buildup of, well, high inventories, both at the channel level, meaning retailers and distributors, and also at Havells' own warehouses. This is particularly challenging right now because we're heading into the low season for AC sales, so moving that inventory quickly isn't straightforward.
Right.
Havells estimates it will likely take maybe a few months for the entire supply chain to fully readjust and for those inventory levels to normalize.
Okay, a few months. And what about Lloyd? You mentioned management sounds optimistic despite the weak quarter.
Yeah, regarding Lloyd, despite its weak Q1 performance, management remains quite optimistic that the brand is on the right path for both revenue growth and profitability. And they have some tangible evidence for this. Lloyd has shown a significant improvement in its contribution margin over the last 2 years.
That's key.
It really is. Because it means for every unit sold, the profit contribution is much stronger, even while they're actively investing in brand building and, deeper market penetration. Havells explicitly stated they won't be resorting to heavy discounting to clear inventory. It's just not their long-term strategy.
Okay.
Instead, they believe their supply chain has better adjustment capabilities to manage this. And on market share, Havells contends they've either maintained or even gained share in RAC and fans, even though the room cooler segment saw a sharp decline due to what they termed seasonal destruction of demand. So yes, the numbers were tough, but they see it as a temporary blip, not a fundamental shift.
Got it. So the cooling business hit an unexpected chill, leaving Havells with some inventory to work through. But even as that segment cools off, another part of their business has been absolutely heating up, their cables and wires division. This is clearly the powerful growth engine this quarter. What were the core drivers behind that incredible performance, and what's the long-term strategy here?
Cables and wires truly were the standout, no question. We saw volume growth of around 21%.
And overall value growth came in at a robust 27%, with very similar growth rates for both cables and wires individually. This impressive performance is primarily attributed to strong demand, particularly from infrastructure and industrial sectors, alongside the successful rollout of Havells' expanded capacities in underground cables.
Ah, the capacity expansion paying off.
Exactly. And looking ahead, Havells has an ambitious plan. They're aiming to double their capacities in underground cables between fiscal year 24 and fiscal year 27. This signifies a massive commitment to the sector, with significant investments earmarked specifically for the medium voltage to high voltage segments.
So targeting bigger projects then.
Precisely. That focus on higher voltage cables suggests they're targeting larger, more complex infrastructure projects. They clearly see good growth traction here for the medium term, and they also noted decent growth in export markets for long cables, indicating international demand is strong as well.
And profitability in that segment. Margins holding up. Yeah, in terms of profitability, the contribution margins for cables and wires were at 15% this quarter, which aligns perfectly with their aspiration of 14% to 15%. There was a minor short-cycle inventory buildup due to fluctuations in copper prices, but management expects that to clear very quickly, within like 15 to 20 days. So no long-term concern there. It's a segment that's performing strongly and strategically positioned for continued expansion.
That's a powerful story. Okay, moving on to another strategic area. Often flies under the radar, but crucial for long-term growth in India: rural penetration. What's Havells' strategy in the rural market, and how is it impacting their overall business? It's still a small percentage overall, right?
It is, yeah. The rural market is undeniably a key focus for Havells' long-term vision, though. While it currently comprises a modest 5% to 6% of their overall consumer products revenues, the key thing is it's growing at a faster pace than urban areas.
Okay, that's important.
Definitely. Havells is employing a very calibrated, multi-pronged strategy here. First, they're expanding their product range. Not just Havells branded stuff, but also bringing Lloyd products into these rural markets soon. Second, they're adding deeper distribution networks, reaching areas that might traditionally be underserved. And perhaps most interestingly, they're opening fully branded, full-service stores in very small areas, targeting populations of just 5,000 to 10,000 people.
Really? That's small.
Yeah, really small. And these smaller format stores are apparently showing very good traction, likely because they offer direct access and a full brand experience where it might not have existed before. It's worth highlighting, too, that some of their product categories, like the Rio brand, already see almost 25% of their revenue coming from rural areas.
25%? Wow.
Yeah, which clearly demonstrates the significant untapped potential here. This isn't about rapid, unthinking expansion. It's a carefully executed strategy to build sustainable, organic growth. They're laying groundwork for what could be a massive consumption story down the line.
Interesting. Okay, shifting gears now to future bets. Havells recently made a significant investment in Goldie Solar. This sounds like a pretty bold move into the renewable energy sector. Can you detail that investment and maybe unpack the broader strategic thinking behind it? How does it fit?
This is indeed a very significant and forward-looking strategic move for Havells. They committed 600 crores, that's roughly 6 billion rupees, to invest in Goldie Solar. The primary goal here is to rapidly accelerate their growth in the renewable sector by leveraging Goldie's established solar module manufacturing capabilities.
And the targets sound pretty ambitious.
Very ambitious. They're targeting a jump from about 500 crores in revenue last year to potentially crossing 1,500 crores in the next couple of years from this segment alone.
1,500 crores, that's substantial.
It is. But the strategic importance goes far beyond just manufacturing solar modules or selling solar pumps. This investment actually builds a crucial pipeline for Havells to sell their other core products like cables, switchgear, lighting products within the burgeoning renewable energy ecosystem.
The cross-selling opportunity.
Exactly. Imagine all the wiring, switches, lighting needed for solar installations, whether it's residential, commercial, or utility scale. Goldie Solar is also actively moving into solar cell manufacturing, which is a step up in the value chain, and they're exploring battery energy storage solutions, which is, a massive future market. This clearly reinforces that renewables aren't just a side venture. They are a big future growth possibility and a key strategic focus area for Havells, positioning them for the long-term energy transition.
Makes sense. Okay, beyond these major segments, let's touch on the others: category pumps, motors, and then maybe switchgear, lighting, and electrical consumer durables, ECD more broadly. What's the story across these diverse lines, and what are the key trends impacting their margins?
Sure. In the others category, the decline this quarter was primarily due to pumps, which were affected by, intermittent and unpredictable rain patterns, impacting demand in agricultural and residential sectors. Motors also saw some softness. The overall ECD segment's decline was predominantly driven by the weakness we already discussed in fans and air room coolers, linking back to that challenging summer.
That connects back.
Exactly. Now, for switchgear, Havells is holding firm on its target of a 38% to 40% contribution margin. Management emphasized there are no structural issues here. Any quarter-to-quarter variations are mainly due to product mix. For example, a higher proportion of exports in a given quarter might shift it slightly.
Okay.
They acknowledge that overall consumer demand across their portfolio is still somewhat tempered, but they anticipate a significant pickup in the second half of the year, driven by the festive season and, importantly, by real estate-led finishing state demand. That's when newly constructed homes need all the electrical fittings, lighting, and appliances.
Got it. And lighting. There's been price pressure there, hasn't there?
There has. In lighting, there's been a noticeable 10% year-over-year decrease in LED prices, which was a market trend. However, the good news is those prices are now sort of plateauing sequentially.
Stabilizing,
yeah, which is a positive sign. Havells expects growth in lighting by strategically focusing on high-end premium products and solution-oriented products rather than just competing on volume at the low end. This allows them to maintain industry-leading margins even in a competitive market.
Sure.
Regarding overall margin trends and cost rationalization, look, while Havells continues to invest in manpower and capabilities, especially in segments like lighting and Lloyd, the core aim is to achieve operating leverage from their fixed expenses. This just means as revenue grows, fixed costs are spread over a larger base, leading to higher profitability. They're also actively readjusting expenses as their channel and product mix evolves. Shows strong operational discipline.
Okay, good overview. Finally, let's touch on inorganic growth, M&A. Given some market chatter, what's management's stance? Are they actively looking or more wait and see?
Management is quite clear they are open to inorganic growth, but, and it's a big but, with very specific criteria. Any acquisition has to be of a certain size, which could move the needle, meaning it needs to be substantial enough to genuinely impact their overall business, not just a small bolt-on.
Makes sense. Needs to be meaningful.
Right. And furthermore, it must be complementary to their existing categories, either allowing them to double down on a strong existing segment or adding adjacent categories that create synergy. They emphasize that they already have a very large organic portfolio with a lot of exciting internal opportunities for growth. That's their primary focus. However, they concluded with that classic phrase, never say never on the inorganic, indicating that while organic growth is paramount, they remain opportunistic should the right strategic acquisition present itself.
Okay, never say never. Got it. So to try and synthesize this complex picture then, Havells India navigated a truly challenging Q1, particularly on the consumer side, by focusing intensely on cost discipline, accelerating strategic investments in high-growth areas like cables and renewables, and diligently executing that calibrated long-term rural expansion strategy. Feels about right.
Absolutely. The transitory nature of the challenges in their cooling products, combined with the sustained strength in infrastructure-led segments like cables and wires, truly highlights the resilience you get from Havells' diversified portfolio. Their aggressive push into renewables and high-voltage cables isn't just about current trends. It squarely positions them for long-term secular shifts in India's economy and energy landscape. You can see the long game there.
Yeah, definitely.
Furthermore, that relentless focus on margin improvement across all segments, even in competitive markets, signals a deeply ingrained operational rigor. They're watching the pennies. And the calibrated rural strategy. That's a clear, calculated long-term play on India's evolving consumption story, indicating they're building foundations for future decades, not just thinking about the next quarter.
All right, well summarized. It's time now for our This Is Not Financial Advice segment. Just a reminder, these are our outrageous but plausible trade ideas presented purely for thought-provoking discussion, not recommendations.
Okay, my trade idea for Havells, given this deep dive, is a long Havells, short consumer discretionary ETF pair trade.
Okay, interesting pair. Unpack the thesis.
Right, so the thesis is this. The Q1 challenges for Havells' consumer products, like their ACs and fans, appear genuinely transitory, just like management stated. Their strategic investments, however, are heavily skewed towards infrastructure-led segments, cables, high voltage, and critically, that bold push into future-facing renewables, solar, maybe even battery storage down the line. This unique diversification positions them fundamentally differently from the broader consumer discretionary sector you see.
Right, they're not just a consumer play.
Exactly. While the market might broadly penalize consumer stocks for slowing demand and high inventories, Havells' robust industrial tailwinds and their clear long-term growth story in renewables should allow it to significantly outperform. The current high inventory in cooling products will eventually get cleared. Perhaps a stronger monsoon helps rural demand bounce back. And their consistent rural growth provides a stable base many pure-play consumer stocks lack. This trade essentially bets on Havells' specific operational strength and strategic diversification, fundamentally overcoming broader macro consumer weakness.
And the mechanism. How would you execute that?
Simple enough. Buy Havells stock directly and simultaneously short an exchange-traded fund, an ETF that tracks the broader consumer discretionary sector. Maybe a diversified Indian consumer discretionary ETF. A potential trigger for this trade to really work out could be, say, a strong monsoon season, leading to a palpable rebound in rural demand and overall consumer sentiment in Q2 or Q3. Coupled, of course, with continued strong order books and project execution for those infrastructure projects driving the cables business.
Got it. Long halves, short consumer discretionary ETF. Outrageous but plausible. And here's a provocative thought for you, our listener, to chew on. What if the transitory challenges we're seeing in consumer goods aren't just temporary, but actually a subtle catalyst, pushing companies like Havells to accelerate their pivot towards more resilient, infrastructure-led, and future-ready segments, fundamentally reshaping their long-term growth profile and making them, well, a different kind of company entirely, something to think about.
And just to reiterate very clearly, this was a deep dive into the information presented during Havells India Limited's Q1 fiscal year 2026 earnings call. It should absolutely not be taken as a recommendation or financial advice. We always encourage you to conduct your own thorough research and consider multiple perspectives before making any investment decisions.
Absolutely critical point. Thank you for joining us on the deep dive for this exploration into Havells. We hope this has equipped you with some truly valuable insights. Be sure to tune in for our next session as we continue to unlock the intricate world of corporate earnings.